Most people believe the Federal Reserve was created to stabilize the American economy and protect the public from the anarchy of unstable private banking. Welcome to a different perspective at the Bookish Breakdown. Everything we are exploring today comes directly from our methodical breakdown of the book, The Creature from Jekyll Island. This investigation exposes a system conceived in secret by competing financial empires to socialize their inevitable losses and legally force taxpayers to cover their bad loans. The institutional reality of the American financial system remains hidden from those who only look at the transparent halls of Congress. In November 1910, at a New Jersey railway station, 7 men boarded Senator Nelson Aldrich's private rail car under the cover of darkness. They arrived separately, avoided all reporters, and used only first names to hide their identities from the train's crew. These men represented the great financial dynasties of the era: the Morgans, the Rockefellers, the Rothschilds, and the Warburgs. Together, they controlled an estimated 1/4 of the total wealth of the entire world. Their destination was a secluded millionaire's resort off the coast of Georgia called Jekyll Island. Normally, these titans were fierce competitors, but they were driven together by a mutual threat: the growing competition from thousands of new banks springing up across the country. They recognized that this independent competition was cutting into their centralized power, and they understood that the only way to eliminate it was to form a cartel. Cartels have a fatal internal flaw: members eventually break the rules to gain a competitive advantage. To prevent this, they needed the federal government to legally enforce the cartel, forcing all banks to operate under the same reserve ratios. They also required a lender of last resort to manufacture money, bailing them out when massive commercial loans inevitably defaulted. This blueprint protected reckless banks from the consequences of their own bad loans and effectively shielded the elite from the risks of a free market. When a commercial bank creates money to lend to a massive corporation or a foreign government, it collects the interest as pure profit. When that borrower inevitably defaults, the bank simply rolls the debt over, extending the loan and upping the ante by creating additional money so the borrower can keep making interest payments. When that charade collapses, the bankers approach Congress, warning that if the bank is allowed to fail, the entire national economy will collapse into chaos. This playbook was used when the Penn Central Railroad went bankrupt in 1970, and again in 1982, when the FDIC and the Federal Reserve orchestrated a rescue for continental Illinois. The government guarantees the loans, transferring the burden of the debt from the bank's private ledger directly onto the backs of the American taxpayers. This is the kind of investigation we prioritize here at The Breakdown. Hit subscribe to follow where this trail leads. This newly created bailout money floods into the economy and dilutes the value of the dollars in your pocket, meaning you pay for the rescue through the hidden tax of inflation. Paul Warburg masterminded the strategy to convince Congress and the American people that they were creating a measure to protect the public. Warburg's plan relied on a specific vocabulary designed to obscure the institution's true nature. They chose the name Federal Reserve System because the words conjured the image of the federal government and sounded financially secure. To create the illusion of decentralization, they established 12 regional branches, masking the fact that power would be firmly consolidated in New York among the elite financiers. The entire architecture was a facade, designed to allow the bankers to keep the substance of private control while appearing to be a government agency. President Woodrow Wilson and Congressman Carter Glass helped sell the deception to a skeptical public. Wilson privately admitted to Glass that they were giving the public the shadow of a government agency while allowing the bankers to keep private control. The Federal Reserve acts as a legally enforced cartel, ensuring that elite profits remain private while their massive losses are socialized. This system has locked the nation into a cycle of perpetual debt and engineered boom and bust cycles that systematically consolidate wealth at the very top. We will next examine exactly how this central bank conjures money out of nothing and the step-by-step process used to transform government debt into the currency we use every day.